Okay. So now let's try to understand the AR or accounts receivable textbook concepts and the I can say NRV textbook concepts. So the textbook simply says about accounts receivable that accounts receivable represent the money customers and other owe to the company, typically expected within a short period. That's why we call that as a current assets. Now there are two kinds of accounts receivable which we had seen. First accounts receivable is the trade receivables which are from our customers, which is like whatever money we receive from the customers for buying the company's primary goods and services, because that is the work of the primary company. If we talk about Starbucks, so coffee selling becomes their primary goods or services. It's not the any machinery selling company. So whatever primary goods or services they sell, that becomes their primary goods and services, and that becomes a trade receivable. And the classification will always be the current assets. Why? Because generally the money may be received from the customers within a period of maximum by 12 months. Now the non-trade receivables are like from others, which is like money owed from other than regular sales. So if Starbucks sold one of its machine, then it's like it's not the job of Starbucks to sell the machines, right? But if they are selling the machines on irregular basis, then that becomes the non-trade receivable. For example, advances given to employees, just like we see in the example below. In the previous video, insurance claims or tax refunds due from the government, and the classification will depend whether its time period is within 12 months or it's beyond 12 months. If it's within 12 months, then it will be a current asset, or if it's beyond 12 months, that it will be a non-current assets, depending on when the collection is expected. Okay. Now along with that, let's see the net realizable value textbook concept as well. So NRV is a critical measure of net cash amount the company realistically expects to collect. So basically you may sell for $100 to a customer, but if there may be chances of bad debt for $10, then ultimately you will be receiving $90. So it's the net cash amount which you are expecting from it, your receivables. Now how to do the calculations for that? So it will start with the gross AR balance, which is grossly how much money you need to receive, and we need to subtract the following for adjustments. So we need to subtract the bad debt, and we call that as allowance for uncollectible account. Then this is known as bad debt. Next we need to reduce is the allowance for sales return and allowances, because we know some people will be returning the goods, just like in the Starbucks case we saw. And lastly, there is an allowance for sales discount, because we give the discounts to our customers as well. So primarily from our gross AR balance, we reduce our bad debts, we reduce our sales returns, and we reduce our sales discounts, and that gives us the net realizable value, or what we call as NRV.